Hi everyone. Today our discussions will be about corporate governance. I will summarize the whole thing about corporate governance for all of you. So the corporate governance actually developed quite recently because of the about 15 years ago, I think. It's because of the organizational collapse of the Enron and WorldCom because of their weak corporate governance. The corporate governance in this case we are talking about the director, the structure of their NED. NED in this case is the non-executive director, as well as any top management figures, for example CEO, CFO, all this thing. So the first thing, what is the definitions of the corporate governance? Corporate governance is defined in the Cadbury report in 1992. It was stated as the way the company is directed and controlled. So what this means? We can see in the case of the Solomon and Solomon. The Solomon and Solomon, it says that the corporate governance is about a system of check and balances in which is done both internally and externally in order to ensure that the director within the company are discharging accountability to the shareholder. Clear, right? And it further on and stated that to ensure that the company are behaving socially responsible to the stakeholder. Still not understand, am I? Another professor is said, Professor Bob Dicker. Professor Bob Dicker said that all the company needs the management. Management is about running the company, but corporate governance is ensuring the company being run appropriately and properly. So these are basically the three definitions that is more widely used. So the purpose of the corporate governance is to reduce the agency problem created by the separation of the ownership and control between the shareholder and the director, where the shareholder already discharging their day-to-day running responsibility to the director to help them to run. The problem arises when this director, they do not do what the shareholder call them to do. They pursue their own interests. In corporate governance, we call this the opportunistic behavior, the self-interest. They pursue their own interests. For example, they entering into related party transactions. They use their own company to sell the things to this company. So they earn a high, selling very high, then they approve the payment. Then another company which is owned by them will be earning the high revenue. In the case, they will put all their money into their pockets, basically from the shareholder. So the corporate governance, in order to reduce this problem, it proposed two things in order to reduce this, what we call the agency problem, because of the opportunistic behavior of the director. So they do this by imposing the monitoring and also the incentive. Monitoring, in this case, the shareholder already appointing two persons. One is called the non-executive director, which is not involving in the day-to-day running operations of the company. They play three roles. This entity, remember, is three roles. The first role they are playing is the strategy role. They are contributing to the running of the business, contributing to the strategic decision. What they say is actually because the NED, all these are actually retired director, previously also director just from another company. So they now retire, have nothing to do. So they do not involve in the operation. They share their experience over the years they have accumulated in their service in the field. Maybe the best thing in corporate governance is that all the NED must come from different background and diversified one. So they will to contribute more effectively to the strategic decision making in order to prevent the dominancy of one director, the CEO or the chairman combination. They need to avoid all these things from happening. So another role played by the NED is actually the monitoring role. Monitoring role is one to monitor the director behavior. They can do three things under this monitoring role, in which are the risk role, the people role, and the performance role. The people role, they are sitting actually on the remuneration committee. Then they will be selecting all the future director that is necessary for the success of the company. They will be involving in the succession planning of the company, as well they will be selecting the director based on the composition, whether the board actually reflecting the compositions of the society. Because the corporate governance practice say we need to be diverse in terms of the age, gender, qualification, experience. and the nationality, religion, anything. You need to be diverse so their decision may be more sound, because taking into account the different view into a particular situation. This is what the corporate governance said lah. So another thing about the risk role, another thing is the risk role. The risk role is by sitting in the audit committee or the remuneration or the risk management committee, the audit committee and the risk management committee. These two committee, actually the AC sometimes the audit committee will be sitting, if don't have the risk management committee, then the audit committee will play the both role. So if not, they're actually separated. The risk management will be identifying the risk for the company, help them to assess the probability, and proposing any recommendation for improvement or tackling the risk, whether to accept or not. For example, in a particular acquisition or disposal of a company in which the company in which going to enter into, so they propose to it. This is the first thing. The audit committee is overseeing the internal control structure of the company as well as the financial reporting of the company. So they need to ensure that the internal control system is sound, and also the financial reporting is integrity, so that the information communicated in the financial statement is true and fair for the user, the shareholder, to make the relevant investment decision. So after this has been completed, the last one is the performance role. Performance role normally refer to the CEO. The NED will oversee the CEO to see whether the CEO actually are doing their work, actually performing up to the standard expected by the company. Normally every year they will set a performance target for the CEO. So to see the CEO whether can achieve or not. If they can achieve, mean is performing. Not achieving mean performing. If not performing, they will hold the CEO accountable for the worst performance they have performed actually. So maybe call them for any warning letter, or maybe resigning, call them to resign or sack them away. However, sacking them will involving a high amount of sum called the severance payment, which is equivalent to their notice period. If 1 year, then will be 1 year salary if you want to sack them immediately. So these are the NED. So basically that is about the how to manage the relationship between the NED and the ED. Another monitor role, just now we said we appoint two persons, right? One is NED, another one is what? Is appointing the auditor. The auditor is normally accounting firm. They assign an accounting firm to audit the company. Then subsequently will this, whether to appoint this accounting firm as an auditor or not, will be discharged by the, just now we said, the audit committee. So they want to see whether the company is actually working or not. Actually the financial statement, normally it's about the financial statement and internal control. Depends on the country. The financial reporting, you see, conducting the audit at the end of the year and maybe any interim audit to ensure that the financial statements are true and fair, complete and valid in this sense. So which means all the transactions are actually reflected in the financial statement, no fraudulent purchases, no fictitious payment, all these things don't have. They need to ensure that, because actually they scared the director misuse the fund for their own purposes. This is a thing lah. So another thing was they use the incentive. Just now we say monitor how to ensure the director achieve their aim. Achieve their aim, we use incentive. Incentive, we say the remunerations. The remuneration, the money they paid to the director. They do not base on salary, or not just on salary. They divide into two components. One way of dividing the component is what we call the short term and the long term. Another way is what we call the performance related and non-performance related. For the short term performance one, non-performance related one, are what we call the salary, which is based on the qualifications, the experience, their specialist skill, the availability of the same caliber person in the market, their negotiating power, all these things need to take into account. So about salary, the performance related here will link to the performance, normally linked to the performance of the company. So in terms of the bonus, company share, share options, benefit in kind also actually fall under those performance related. They need to reflect the director. The principle using here, the remuneration, it must be able to attract the director to come to the company, retaining in the company and motivating them. How to motivate? Use the just now the performance related one. After this has been completed, then we went on further to say, After this has been completed, we assume the director will work for the company, not just that, right? So actually, in sometimes the company, the director, the CEO and the chairman are the same person. CEO will be involved in the running of the company, chairman will be running the board. If on the same person, it's become the same person, then no one will be monitoring the CEO. In corporate governance, we call this, they give the CEO the unfettered power. They can do whatever they want. They can use the power to their own advantage. No one can control them. That's why they say need to separate these two roles, so that the chairman able to hold the CEO accountable for any malpractices or any underperforming. Without this, the chairman cannot act as an independent third party. Independent non-executive director normally consists of is a person which is a non-executive director, and independent. Independent in this sense are what we call free from personal interest, family relationship, and any financial interest in the company. So they are very independent. They wholly discharging their responsibility on behalf of the shareholder to help to monitor the CEO actually running the company. After this thing have been said right just now, the director remunerations, then we talk about a little bit about internal control. Corporate governance also concerned about a little bit about internal control. Internal control we use here is the Turnbull one, the Turnbull report. Using the Turnbull framework, we say consists of 4 things, not 5 things actually. The control environment, the control activities, the timely reporting, monitoring, or 4 things. It's about 4 things. So the control environment here is talking about the culture, whether the management themselves are actually disciplined themselves, whether are ethical, actually are very concerned about the internal control, their effectiveness or not. In the case of the control environment, there are 4 types of control that can be imposed within the company, namely the financial control, the operational control, the compliance control, and the risk management control. It's the risk management system, actually, what we say, is put in place in the company. The financial control having the impact of ensuring the financial statement actually true and fair, able to preparing the financial statement on a timely basis, communicating all the relevant data to the management in order to make their management decisions, ensure that the decision made are more sound. These are basically the things that the financial control do. Then the operating control, which put in place in the operation of company, ensuring achieve 3E. 3E actually stands for economy, efficiency, and effectiveness in order to achieve the value for money. Economy in this thing, we say buying the same quality of goods at a lower price is the simple sense. Efficiency we mean achieving the same output with the lowest input available, which means use the available input to maximize the output, also what we can say like this. Another one is effectiveness, achieving the aim of the business. For example, providing goods and services to the public. Want to achieve 30% of market share this year. This is their effectiveness. Need to achieve the aim of the company. In the compliance control in simple terms, what we say, ensuring the company is compliant with the relevant law and regulations in which they are operating into, and also the internal rule and procedure. Internal rule which the SOP within the company, so they need to ensure comply. And another one are called the risk management. Risk management is covering about the 4 processes. Not only 4, actually it's 5, this one. In this case 5. It's the process of identification any risk that is present within the company, internally or externally, which may be threatening the ability of the company to continue as a going concern. Then we need to assess whether a particular risk, what's their likelihood of occurring, and also their impact will have on the organizations. And then developing the appropriate strategy in order to help the organization to tackle the relevant risks, and also continuously monitor them, whether any new risks have arises, old risks have died off, or any changes in the probability or the impact. All these things are the risk management. And the last thing that involving is the reporting. Reporting by who? The risk management department. Risk management department will report to, just now we say the entity, right? The risk management committee. The risk department will report to the risk management committee, and the risk management committee will report to the board to tell them what is the risk that is present in the company, what is their strategy to tackle them. They compile all this under one document called the risk register. After this all have been completed, right? After this all have been completed, then just now we say what? Oh, the control activities. Then we come to timely reporting. Under the timely reporting means the management inside must be timely reporting all the information to the top management to ensure that the decision made are more sound and any corrective action can be made. Another one, the communication here can be talked about establishing a whistleblowing arrangement within the company. Whistleblowing in this case means allowing anyone who wishes to raise any issues about the company, the malpractices of the senior management, they can tell the department, normally undertaken by the audit committee. And the last one is about we talk about the control activities, control environment, timely reporting, and the last one is about the what? Timely reporting. It's about the monitoring. The last one is monitoring, same as the risk management, to ensure that all this control, just now we say the control environment, the control activities, and the reporting, all this will actually discharge according to what is supposed to be done to ensure all the necessary control are in place and apply as prescribed. So this is basically the internal control. After the internal control, we talk about three things already, right? The director remunerations, about the internal control. Then the last one we talk about is the relationship with the shareholder. In the relationship with the shareholder, how a company maintain a good relationship with the shareholder is two things. One is disclosure, another one is about communication. Disclosure, here we mean disclosing all the information that you use internally as far as practicable within the company to disclose it to the shareholder or other stakeholder. But here we concern about the stakeholder to ensure that the company achieving its objective of communicating all the necessary information that is relevant to the shareholder, in order to reduce what's problem, the information asymmetry. Information asymmetry, because this problem arises when the shareholder do not involve in business. They do not know what is inside the business, what they are doing. So that's why they need need the director to actually disclose all this information to let them to understand. The next thing about this was disclosure must be in terms of over and above the law and regulation requirement, which means the voluntary disclosure is very important because they need the shareholder to have confidence in the company. They are actually very transparent and open to them. So the shareholder have more confidence. This will increase the shareholder loyalty towards the company. Basically this thing. Another one just now we say is the communication, right? Communication with the shareholders, normally you can done to AGM, the annual general meeting, the entering into dialogue if in case of an institutional shareholder. Institutional shareholder is a very big shareholder, it's a pension fund or a unit trust. It's an institution which hold fund for multiple investors in help them making the relevant investment management decision. This is a big shareholder, small shareholder. One is through AGM, one is through dialogue. Another one is through website. Inside the website there is one thing called the investment relation tab, right? They disclose all the latest information to the shareholder in order to maintain the latest updates to the shareholder to let them to know what is happening inside the organization. So basically this four things is about the whole thing about the corporate governance best practices. It's actually to help the shareholder to have more confidence in the company, able to put more money. Actually this relates also to the stock market. Because stock market, all the stock is from all the companies, right, listed company. So all the listed company will continue to attract more investors to put funds in the company. So the corporate governance to ensure that the stability and also the continuity of the fund and the working of the whole stock market. Actually all these things is because of all the directors do not play their own role. That's why this thing need to be established, the corporate governance. However, this is just all about the corporate governance in a nutshell that I know. I know it's very long, but it's a very smart summarization of the whole corporate governance topic to all of you. Thank you very much. See you again.